November monthly macro webinar. It's been, I think, in many ways, it's been a very interesting time. I think probably from a macro perspective, what we're really seeing is less of the story from my perspective of sort of the K-shaped economy, although that is part of an underlying dynamic that's going on, and more when I look at the markets and the economy, what I see is a big divergence between the AI mania and what's happening in the rest of the real economy. And I think these charts are illustrative of that overall dynamic, which is, if we look over the last year, the equal average S&P 500, which is closer to what the real economy mix is essentially flat over the last year, which is, not particularly compelling in terms of return. And when we look at the overall market, what we see is that, it's up considerably over the course of the last year. These are a couple days out of date, so they don't reflect yesterday's market action, but you get the point that there's been a big divergence between the overall index and essentially what's happening with the average company in the U.S. economy. And the same if you go over and look at the right-hand side, basically what is driving that entire outperformance. It's basically the mega cap, Mag 7 type names, which are meaningfully outperformed the market over the course of the last year. And so we really do have the sort of AI theme, which is driving the vast majority of the markets, and the real economy, which seems to be meaningfully lagging. And so inevitably that means that we've got to take a look at that in more depth. Usually as a macro person, you don't spend a lot of time thinking about particular companies' outcomes or particular necessarily themes unless they get to sort of that macro influential level. And obviously the AI story has now become at that level, particularly since it's driving essentially all of, or more than all of, the aggregate market moves. And we see this in a couple different ways from a macroeconomic perspective. First, in terms of what drove growth over the course of the beginning of the year, which was, significantly driven by front running of tariffs, leading to significant AI-related investment. And so if you look at the first half of the year, basically GDP growth in aggregate slowed. It slowed a lot more when you exclude the investment that's gone into software and various info processing equipment, which together probably roughly make up the AI effect, the sort of direct AI effect on the economy. And over on the right-hand side, just highlighting how, business investment outside of AI-related investment is essentially zero. It's fallen considerably. Whereas if we go back 2 or 3 years, basically, AI and software-related investment was modest. And so basically all we're seeing is business investment. All the business investment we're seeing is related to AI infrastructure and tech infrastructure, and that investment related to AI and tech infrastructure is driving a significant portion of economic conditions, leaving the rest of the economy, falling behind. And that's probably, in many ways, it's a bigger and more important theme than sort of the different income cohort type of analysis. Now, when we look at this AI-related investment, what we're seeing is a consistent upsizing of expectations of the magnitudes of this AI investment. On the left-hand side, what you see is analyst expectations of hyperscaler Capex each year, how it's evolved over time. And what you can see is that really in the last couple of years, there's been an incredibly sharp rise in expectations of forward-looking Capex. At this point, 2028 numbers are penciled out by analysts to be roughly $550 billion of total Capex from the hyperscalers. Now, the thing that's interesting about that, while that represents a significant surge in terms of the magnitude of the investment, in a lot of ways, what we're seeing right now, and possibly earlier this year, is the maximum support to growth. Now, that can be a little confusing. Even though the level of investment is likely to continue to rise, what matters most to growth rates in the economy is how that's changing, meaning the growth rate of that investment. And so this year, and in particular, we're in sort of the maximum growth rate, moving from lower investment to higher investment, which has created the maximum support or growth impulse on the US economy. And that's important because what that means is if you're thinking that the US economy is going to continue to grow, you're going to get the same growth rates ahead as a function of this AI capex. Well, then it's going to have to continue to grow at the same rate, not just increase in total level of size, which will help support the level of GDP. It has to continue to grow at the same size. And what does this mean in terms of the type of activity? I think the biggest story here is that we're transitioning in this capex as it's gone from a few $100 billion a year to penciling out $500 or $600 billion a year. We're transitioning from this capex being mostly a story of the hyperscalers financing it out of cash flow to the point where basically it's going to consume all of their free cash flow, and we're starting to see the need to borrow in order to meet those very high expectations in terms of investment. And the right-hand chart shows that basically when you take the capex share of operating cash flow less any dividends and share repurchases, it's basically gonna eat all the free cash flow of these companies pretty quickly. You're basically there, and it's gonna at a minimum represent sort of 50, 60, 70% of the total free cash flow that these companies are generating right now. Now, if you go back to 2028, it's essentially expected to represent 100% of the free cash flow from these companies. And so as a result, what we're seeing is what you'd expect, which is a bunch of issuance of bonds, because using all of your free cash flow for this investment is not necessarily a smart financial move. And since most of these companies have core operating companies that are generating plenty of free cash flow, it makes sense that they would go to the debt markets in order to help finance these activities. And we've seen a real surge in the amount of bond issuance from these companies just in the last couple of weeks. So you look at that whole picture, and the way I would think about it is basically we have a story where you have these hyperscalers with these sort of old company businesses that are generally generating positive cash flow. They're pretty profitable businesses, whether you talk about Meta's advertising business or, Google has YouTube and search. Those are generating a fair amount of free cash flow. And essentially each one of these companies is making an enormous bet, essentially betting all of that free cash flow on the AI infrastructure boom that's going to turn out to be profitable ahead. And I think the question then becomes, these companies, the question is not whether there'll be a whole bunch of capex, although it looks like the capex growth rate is likely to slow. The question for the aggregate markets and for these companies as a whole is about whether all of that investment is actually going to pay off with a reasonable ROI. Because if, for instance, these companies themselves are going to invest a whole bunch into this investment, and they're not going to see much of a return on investment, or for instance, a negative return on investment, well, then that's going to be, lead to quite a different outcome than what's currently priced into their equity market, into their stock prices, which is basically expecting very, very good outcomes related to all of this capex. And so I think looking at a couple of real world examples is important, because what you can start to see when you look at those real world examples is that the closer you get to the real economy, the less effective this AI story becomes. And so, on one side, the most extreme, like a NVIDIA, where, NVIDIA is essentially just selling the chips into what all these folks are doing in terms of their investment. Yeah, they're doing great because there's tons of investment. That's kind of obvious. And they're one of the big chip suppliers. That's not really the question at hand. The real question at hand is whether the folks who are investing are going to actually be able to see a real economy payoff, or whether the real economy producers are actually going to be able to use all this AI to generate income for themselves. And so I find Meta as one of the most obvious companies to take a look at because they don't really have, they're investing a ton in AI infrastructure, but they don't really have revenues beyond their um, traditional marketing business. And there, what you see on the left-hand side is their sales, and just below in the blue, and just below that, their sales growth. And if I was looking at this and knew nothing about what was going on, I'd say, yeah, it looks like a company that is, modestly growing over time in terms of its sales growth, possibly some stabilization at high levels after, a decade plus long period of time of growing sales and capturing market share. And you could possibly make the argument that there's been a little uptick of late in terms of their sales, uh, possibly related to this AI capex, but by no means is this a huge amount of incremental revenue. So you look at that and you basically say, it's a few $1 billion of incremental revenue on a quarterly basis. When you compare that to the amount of investment that's going on, which is something like $70 billion on an annual basis, you look at it and you say you're getting a very marginal amount more of revenue, and you're investing $70 billion into that. And what that highlights is that there's a big divergence between the amount of investment that's going on and the amount of revenue production that's actually happening. And I like looking at Meta in particular, because their revenues are real economy revenues. So it's basically saying, look, you can invest all you want in the AI capex. It doesn't really matter when it comes to actually generating revenue, because, what's driving the total desire to use Meta as an advertising source is not particularly well connected to all this AI investment that's going on. And it's not just a Meta story. What you're seeing is across the real economy, lots of indications that maybe this isn't necessarily the boom that is largely expected. On the right-hand side, before we had the government shutdown, the census started to do, or was doing, bi-weekly surveys of companies about their AI adoption. And what we see actually is that, AI adoption, there's some indications that AI adoption is actually starting to slow. This chart on the right from it's BCA showing this Census Bureau survey, suggests that actually, there's been a lot of slowing in terms of what's been going on. And so there's a lot of hope for AI investment, which you see all the way on the right. But the reality is, we're a long way away, and the total percentages here aren't even that high. Then you start to talk about, companies in terms of the model creators, in terms of what does their revenue picture look like with all this investment. And I mean, OpenAI has got to be one of the more interesting ones of these companies, where recently Altman talked about the need to invest roughly $1 trillion of total capex spend over the next 2 years in order to meet needs for compute. And when you look at that and you say, okay, you compare that to the current revenue projections from OpenAI for this year, you're talking about $13 billion of revenue this year. And so what would that mean? Investing $1 trillion into the capex, what would that have to have in terms of revenue just to make that worthwhile? And remember, the depreciation schedule of this, because of the innovation related to chips and the physical nature of the high value components, the depreciation schedule of this stuff is like 5 years, let's say, give or take. And you can actually triangulate that with how the depreciation is being calculated amongst several of the companies offering predominant services related to compute. And so you look at that and you basically say $1 trillion of investment over the next 2 years, $13 billion of revenue this year. You'd have to have trillions likely of revenue in order for that to make sense, or at a minimum hundreds of billions of dollars in revenue in order for that to make sense. And when you look at it, what's happening with the actual results is OpenAI is losing something like 50-ish billion dollars a year, which is fine from the perspective of, they've got a cash, they have a $500 billion valuation, they've raised money, they have enough cash to burn through it. So it's not like there's some, significant borrowing or something like that that's going to be an issue. But what it does highlight is like the need for compute, the investment that's going on relative to the cash flows that are being generated in the real economy. They just don't match. It just doesn't match. And if you look over on the right-hand side, a lot of people have commented about how Amazon's AWS infrastructure has delivered an increasing amount of revenue, a lot of positive reads on Amazon coming out of their most recent earnings quarter. And what you see there is, yep, if you just looked at the bottom chart, the one in blue, you look at that and you'd say, nice, nice increase in revenues associated with AWS, $15-20 billion a year. That seems like a nice business. But then you look at the top and you basically say, what is the investment that they're doing in order to deliver that? Now, not 100% of Amazon's investment is related to AWS, but a significant majority is. And they're investing currently at $120 billion a year. Again, if you look at the increases, and they plan to do so over the course of the next couple of years, you look at those numbers, you say $20 billion increase in revenue, to be generous, and $120 billion Capex, that is a bad ROI. That does not make sense from an ROI perspective. And that's basically the challenge. The challenge that we see right now is what we're seeing is that right now what we're seeing is we're seeing a whole lot of investment going on, and we're just not seeing a lot of real world outcomes. And I like this this chart on the left-hand side, which I cribbed from Columbia professor Brett House. Robert Solo's quote in 1987, you can see the computer age everywhere except in the productivity statistics. And then, of course, on the right-hand side, look at the productivity statistics, and what you see is that you really can't see AI adoption as being a meaningful driver. And I think in part what that highlights is that the typical adoption of technologies follows this sort of J-curve model where there's a lot of investment to try and come up the curve. A lot of that investment is not particularly competitive or relevant or has a particularly high ROI, whether you're talking about the early personal computing boom, whether you're talking about the railroads, all of these different, the early internet, right? Lots of investment at the outset, with it taking a long time to actually deliver the type of productivity enhancement that is being expected in the market. And I think, in many ways, what we're facing right now is almost the bottom point of this J curve in terms of the very weak the weak productivity enhancement that you're getting with essentially the maximum market elevation. And so I think that when you add this all up and you come back to what's driving the majority of this market, you have to have a pretty extraordinary view on AI in order to believe the current prices that are priced into the market. Essentially, more than 100% certainty of an AI boom, both in investment and in productivity, is being priced into the market at a time when the real economy outcomes are looking, I describe them as subdued at best. And so when will that recognition occur? Is that reality? Of course, we're not certain about it. There could be, it could be a more meaningful productivity boom than what we're already seeing, or the trajectory we're already seeing. But if it doesn't occur, there's going to be a mismatch between what's priced into these markets, into these stocks, relative to the ultimate reality. And that is, when does that happen? When does that mania start to move towards reality? Very hard to know with such things. But we've seen time and time again that that gap gets closed at some point where the reality comes to fruition. My guess is it would take quarters. It'll take quarters, not years, for that to get resolved. In the meantime, we have a real economy that continues to be very soft. You've heard me talk about the income-driven expansion, particularly related to household labor force growth, household job growth and wage growth being very subdued, which has kept the earnings power of of households relatively muted. Now, we've been in a blackout for the last couple of months, so we don't have official jobs data, but we do have pretty good triangulation from both ADP and from paychecks, which together cover about 25% of the US economy and match pretty much the big business, small business mix. And what you see there on paychecks in the upper right is continued weak hiring through October. On the left, in terms of the ADP numbers, still pretty subdued. There's a lot of euphoria about that number for October. Was not particularly exciting. You see the Revelio version, which is in the upper left, which is based on LinkedIn data, which is pretty weak, or the JP Morgan data that was announced, that JP Morgan estimates, which were also negative. I mean, look, maybe it's slightly negative, maybe it's slightly positive, but it's weak. There's no question about it. And the Fed's, the Chicago Fed's work to try and get timely indicators on the labor markets as well, triangulating a number of private sector reads, suggests that the labor markets continue to weaken since the official data was released. And so you've got a pretty weak labor market. I'd call it basically you got zero job growth, give or take. And then you have, because of the weakening labor market, you have wage growth per worker continuing to slide and be soft. And whether you look at the average hourly earnings picture, the last time that it was printed at 3.6% year over year, or you look at the Atlanta Fed wage tracker, also, it runs historically has run just a touch higher. It's at 4. However you slice it, zero job growth, 3 to 4% wage growth, that's not particularly strong in terms of nominal spending power. Notably, we did see in September a slowing of demand from the boom in demand that we saw over the summer. And the timely credit card spending data from Chase that you see over here on the left-hand side suggests quite a weak September figure. Bank of America also showed for September some weaker data. The Chase data ticked up a little bit in October. We'll have to see if that's triangulated with Bank of America. And then eventually, hopefully, cross our fingers, we'll get some official data sometime soon. But it does look like demand is starting to come back in line with income growth. And look, big picture level, where you're looking at Bank of America, which suggests about a 3% nominal year over year spending, or you look at the Chase consumer spending data is about 2% above where it was last year. This is not a spending boom. This is a very weak spending environment. And so I think a lot of people centered on the strength of spending that occurred in the summer, expecting that to continue, and that allayed a lot of fears in the economy. And then you look at the reality, and the reality just doesn't look that strong, whether you're looking at the income side in terms of the spending power side, or you're looking at the actual spending side in terms of private sector triangulation of what's going on. The shutdown, which hopefully is ending soon, and I say hopefully not because us macroeconomists have any have any view on or preference of one way or another, trade markets, whether it happens or it doesn't, but solely from the perspective of for the good of those people affected by it. The shutdown, typically shutdowns, I'll be brief about this because it's probably going to get resolved, but still worth keeping in mind. Typically, shutdowns don't really matter for the macroeconomy because everyone gets paid back. And so it doesn't really influence their spending behavior. It's short enough that it doesn't matter, and everyone gets paid back, so it doesn't affect their spending behavior. What I'd say is we're right on the cusp right now of it mattering, meaning to the extent that you start to see this go on beyond, say, 4 to 6 weeks, if it were to go on for another, into, beyond 6 weeks, we're probably starting to see impact on spending behavior, and we're starting to see a more meaningful impact on GDP growth. Regardless, it'll probably have a roughly 1% drag on GDP growth in the fourth quarter numbers, maybe 1.5, depends on exactly how you think about it. But I wouldn't, but that would be transitory, assuming that this is not persistent. When it comes to policy measures, what we've basically seen is the Fed has already given us all they got, in the sense of, the Fed easing is largely priced in. It's largely affected interest rates. We've largely seen the impact through, the decline in the long end and what has led to slightly lower mortgage rates and slightly more elevated refinancing. But that's basically it. The Fed has done its duty and has done its job in terms of cutting and giving a little stimulation to the economy as a result. But that's been priced in for a few months now, and so unlikely to see much more meaningful effect unless the Fed cuts meaningfully more quickly than what's priced in, which is probably what they're going to do. And certainly with Chairman Powell pouring cold water on the expectations of, the expectations on December, at least a little bit in his presser, it would suggest that, the Fed is not going to be blowing it out with easing anytime soon. Notably on this curve, what you see actually is that the new Fed chair is not really expected to do much at all. Certainly meaningfully, the markets are pricing a story ahead that's meaningfully in contrast to the run at hot me crowd, who's talking about massive cuts once the new Fed chair comes into place. Tariffs continue to be in place and continue to serve as a drag on the economy and a drag on real spending and elevation and continue to pressure inflation a bit higher. There's been a lot of talk in the last couple of weeks about whether the Supreme Court will overrule the IEEPA tariffs, which would be a relatively were tariffs to be extinguished, and particularly if tariffs had to be forced to be paid back, it would be relatively meaningful given it's running at about 350 billion to 400 billion annualized pace. Now, what's notable is that even though the Supreme Court may overturn IEEPA tariffs, there are a lot of different levers that the president can use in order to maintain tariff policy, whether it be 232 on the sectoral tariffs, 338 on the foreign discrimination tariffs, which allow for up to 50% tariffs to be implemented on other countries, or the 301 Unfair Trade Practices Act. All of those are different levers that can be used to maintain elevated tariffs just through a different policy mechanism. And regardless of which particular lever gets pulled, the president has the ability to implement 15% blanket duties for 150 days through Section 122. And so if the Supreme Court rules against the IEEPA tariffs, which certainly seems possible, I mean, you see what the polymarket odds say, that it's about 80% chance that they'll get 80% chance they'll get ruled against. Most likely what's going to happen is that Section 232 tariffs will stay in place. So about a third of the tariffs will stay in place, give or take. The president can then implement 122 immediately, giving that 150-day window to then be able to go and do the work either to do the 232 tariffs in order to maintain them, or to leverage some of these sort of more unusual corners of law and legislation in order to maintain elevated tariffs. And so it was notable what we saw when the Supreme Court started to ask, basically showed that they questioned the IEEPA tariffs in the hearing. What we saw was basically no market reaction in the bond market, and I think because basically there's lots of other levers that could occur that could be used, and indications from the president post that Supreme Court ruling is he's talked a lot about various other mechanisms that he could be using. First of all, how he believes that the tariffs still are justified, and also other mechanisms that could be used in order to effectuate tariffs on the U.S. economy. So probably still in place. Certainly the market reaction suggests that tariffs will continue to be a drag. And then, of course, immigration continues to be a significant drag on the U.S. economy with, basically zero inbound immigration. And I think probably even more interesting what you see on the right-hand side, which is a substantial drop in overall work permits that are beyond just the reduction in inbound immigration, which reflect the fact that existing permit holders in the U.S. are not renewing their permits. They may be leaving either through a forced departure or through their own self-deportation. But what you see here is about 2 million workers per year. That pace of worker permits are being taken out, which is a pretty substantial decline in the labor force growth in the economy. And look, from an unemployment rate perspective, that's helping take what would have otherwise been a pretty material rise in the unemployment rate to be only a modest rise in the unemployment rate. But GDP growth does not care about the unemployment rate. Those two things are totally separate from each other. What GDP growth cares about is overall spending growth. And if households don't have the amount of spending that they need in order to the amount of spending power that they need in order to maintain consumption, then we will have a drag on consumption as a result. When you look at how this is all being translated into financial markets, what you see here is two key things. The first thing is, if you look at the last 6 months, stocks have massively outperformed bonds, reflecting the fact that there are very elevated expectations in aggregate for future growth. I picked 6 months exactly because this was the point in which the let's say the tariff tantrum went down and came back, and so bonds and stocks at this point had basically been the same for the year. They both the tariff tantrum had been unwound. And so I kind of like it from that perspective because it gives you a sense as to like, okay, putting the tariff tantrum behind us, what is the market? How has the market shifted pricing since that point? And that's where you see the substantial divergence between stocks and bonds pricing in very strong growth ahead. The other thing that's probably also important to see is just how all financial assets have rallied over the course of the last couple of months, particularly once there was some indication Fed Jackson Hole really started the story or accelerated the story in the late summer and through basically October. What we saw was basically all asset prices rising about 15-20%. That's shown over here on the right-hand side. That is a pretty huge rise over the course of 6 months, given this is targeted at about a 10% annual target return. And so you see that and you say all asset prices are being lifted. And I think actually yesterday was such a good indication of what we're seeing in sort of the broad mania across asset prices, which is when you had a circumstance where there was a little bit of relief in terms of what was going to happen with the government shutdown. You basically saw every financial asset rally. Everything went up, right? And that sort of broad-based euphoria across all financial markets is unusual and relatively extreme. And so when we look at basically what's priced in across markets, those are basically the two pieces that are the most extreme pricing. Not only is growth being priced to be a boom ahead, but on top of it, all financial assets are being priced to outperform cash significantly. And I think when you think about what's going on in the markets, that's been a good trend to follow. And those that have picked up on it have done a good job. But the question is, how sustainable is that? And I think probably one of the most interesting things is that starting in late October, we have started to see some signs that aggregate asset prices have started to fade a little bit. Maybe some indication that aggregate liquidity, aggregate risk taking that had been at such manic levels across all financial assets is starting to turn, and possibly indicating that the turn is afoot, and that 26 may look quite a bit different than what we've seen so far in 25.